Melamed community, welcome back to Don't Let That White Coat Fool You. I'm Dr. Norma Mobley, along with my friend.
Dr. For Sharon Dixon here with you again.
And we're also going to have our trusted financial advisor, Lamont McIntosh, here with us again, continuing the series on financial wellness. How are you doing today?
I'm doing excellent. Thanks for having me back.
So, we've learned a lot from you thus far, and we want to just keep that going. So, I want you to just take it and run with it and roll. We want to know about strategies based on your career phase, being a resident versus an attending physician versus a practice owner. Like, what strategies would you set in place at those stages?
Well, as you can imagine,
Norma, let me jump in there right quick though
sure.
and tell our community you really want to share this one and you want to subscribe. But you don't want anybody to miss this. So I hated to jump in there on you, Lamont, but I wanted to get that out right quick because I think it's so important.
It's all good. I'm a basketball player. I'm used to pivoting, so it's all good. With that being said, you talked about how would I create strategies or what I would tell people who were at different phases of their career, right?
Mm-hmm.
So with that being said, whether you're an attending, a resident, or a practicing medical doctor, I would say start with the fundamentals, right, based on the stage that you are. And so, for instance, if you are a someone that's in school and you're in attending, so to speak, right, at that time you're still not making no money. You know what I mean? But you're getting all the practice in, getting you prepared for your career path, right? So I don't know what your living situation is, what your background is, but if you have any opportunities to take advantage of being able to stay with family or anything like that, live very, very humbly. Let me say that first, right? Mm-hmm. Whatever that means. If that means getting a one-bedroom apartment or renting a room in your local city, wherever you're studying and practicing that, so be it. Because what you're trying to do is continue to make that sacrifice, but in this case, a financial sacrifice so that you can set yourself up for success once you get to the next phase of your career. And so if you are making any money, from what I hear from my engagement with medical professionals at that early stage, there's no room to really work, right? So if you're getting any kind of stipends or if you're living off financial aid like a lot of folks do or whatever, stack as much money that way as possible in very conservative, vehicles. Let that be something like a savings account, high yield savings, money market, or a very conservative investment portfolio that is liquid, not retirement. Everybody tell you to throw money in an IRA, 401k, things of that nature. Well, that's going to limit your access in the beginning. You want something that may be able to help you bridge the gap between you being an attending and maybe even being a resident. So I'll stop there to see if that makes any sense as you all having that experience before.
So definitely being a resident, so I'm going to date myself a little bit, but back in the 90s, yeah, my salary as an intern was $30,000 a year.
Wow.
So being a single parent, I really did have to learn how to budget, which I think I did okay, but I didn't save.
Right.
I had no investments or anything like that. We didn't live above our means. I kept my same Altima like after it was paid off. Oh yeah, I know, right?
Yeah.
So in that regard, I may have done okay. But as far as building up any investments, zero.
Let me speak to that, though, real quick, unless you have something to add, Dr. Dixon.
Well, I was just going to add, we're all in different phases. So, when I was in residency, same thing, about 30K, but I was married with a child and another one on the way, so making that sacrifice of saying my residency had to be in the city where my mama lived. Because of daycare, so making those kind of decisions were helpful.
Yeah, and I'm glad you spoke to that because, quite frankly, it's not always the sexy thing to say that you're a resident doctor or becoming a doctor and you staying at home with your folks, but it's a practical and a very prudent decision to make. And so I'm not saying that's for everybody. Like you said, Dr. Dixon, it could be, everybody's circumstances is different contingent on their background and what they got going. But for me, I wanted to speak to something that you just talked about. To me, budgeting is the most important thing to do at that stage of your career versus investing. Investing is like, that's a plus, you know what I'm saying? Because you have to be able to function. So even as someone like yourself who owns your own practice, you have to have an operating budget. Mm-hmm. You can't keep the lights on. You can't worry about what NVIDIA doing, right? You know what I mean? So at the end of the day, you got to make sure your fundamentally cash flow, AKA budgeting, is top tier. So the steps towards financial security is managing your cash flow, budget. If there's discretionary income after that, right? Saving, conservative saving. I'm talking about liquid saving in your bank account, whether it's for the business and personally. From there, once you have an adequate amount of savings, and that, again, is predicated on your lifestyle, what your ambitions are for your lifestyle in the future as well, then you go to investing.
Okay.
Right? And then at some point, whether you go the employee path or the solo practitioner path to where you own a business, then you can start taking advantage of some of more of the longer term investment options, whether that be a 401k, or if you're looking for tax deductions and things of that nature from your business revenue, taking advantage of self-employment, pension IRAs, solo 401ks, things like that, where you're building retirement for the future, but you also are saving on what you're paying to Uncle Sam in whatever state that you're operating in.
So one of the things I want to bring out is a lot of times in dealing with patients and everything, I try to make sure that I use layman terms so they understand what I'm asking them to do for their child in regard to medications or what have you. It's no sense in me using medical terminology and they don't understand it.
Sure.
There's a whole different verbiage in regard to financing. And so there's a lot of times I'll read about things like, what's the difference between a Roth IRA versus a 401k match and things like that. So could you explain some of that for our audience?
Absolutely. So an IRA in general, let me start there. An IRA is an individual retirement account. Okay. And then there's different types of individual retirement accounts. And as the name suggests, that's for people that's for individuals. Like, so if me and you were married, you can't contribute to you can't be on my IRA and nor can I be on your IRA.
Okay.
Now, there are some caveats to be able to contribute on each other's behalf because we're married, but I don't want to get into the weeds with that. But individual retirement account. So it's not something that your employer, provides for you. It's something that you fund on your own. Right. And then a 401k is what we call an employer sponsored retirement plan. It's something that a company is offering to its employees as a way to save for retirement. And the match piece that you talked about that's typically something that is provided by companies that have the wherewithal, the solvency and things of that nature to match what you contribute to your plan. Right? Because in 401k, as an employee, you will be a participant in the plan that the employer provides. All right. And so if you put in 5%, they may say, we will match up to 5% dollar for dollar. So if you put in, so let's say 5% of your salary is $100 per pay period. Well, they're going to put in an extra $100. So there's $200 going in per pay period into that employer plan on your behalf. Right. And so that's where that means match.
Okay.
Some companies don't match, but it's a retention tool typically, right? It's like you're trying to attract top talent. You want to have that sort of benefit. Okay. Does that make sense? Mm-hmm. Yeah.
So in terms of the market, can you explain why time in the market is more critical than the actual amount of money that is sitting there?
Yeah. So again, layman's terms, compound interest, right? Anything you ever hear the word compound, it could be in biology and chemistry or whatever the case may be. When you compound something, it makes it bigger over time, right? So that's the same thing here when it comes to investments. That's why you'll hear the greats like Warren Buffett say, for the most part, if you were to put your money into S&P 500 fund, right, which is basically an index, S&P is an index of all the different sectors in the stock market. And if you do that for 20, 30, 40 years over time, you will do very, very well because it's about the consistency and then the power of compound interest over time.
Okay.
It's the same way it works for us in negative ways, right? Which is if you don't pay that credit card bill, that interest does what?
Compounds. Right? Makes it get bigger and bigger.
And the same thing with your mortgage. You bought a house, you got a mortgage loan for XYZ, but the principal is one thing, but you're paying for that house maybe twice if you're not utilizing some tools to be able to pay that note down faster.
Okay. So higher income earners are often hit the hardest by taxes.
Sure.
Okay. What are some tax smart things that we could do in regard to investments as far as vehicles that physicians could utilize?
Well, again, it's really kind of contingent on your career path. If you're an employee, that's one thing. And if you own a practice where you are a business, then there's others, right? So let me start with business one because that's a little bit more complicated. Whereas like you can have an opportunity to designate yourself a certain way. So if you're an LLC or C Corp or something like that. So LLC is limited liability company. C Corp is a corporation. And that's just how you look in the eyes of Uncle Sam. Then you can also become what they call an S Corp. And an S Corp just allows you from a taxation standpoint to be what they call a pass-through entity. Meaning that, you may have Divapedia, Enterprises, LLC, but Norma Mobley is the employee of said entity.
Gotcha.
And so what happens is, and when you're designated as an S Corp, they have this thing in the IRS code where you have to pay self-employment taxes as a business. And that's 15.3%. If you put yourself on payroll, Dr. Mobley as an employee of Divapedia, right? Then you can save 15.3% by just paying yourself a certain salary, right? Predicated on what you need to be able to operate personally. And then from there, you can do certain little strategies to take advantage of that. And as an employee, the biggest thing is take advantage of any 401k options that you have. Obviously, if you have means and the extra to be able to do IRAs where you can take a tax deduction, that'll help you out as well.
Okay. And the company I work for even has a stock plan. So opportunity for you to take advantage of that, I would think would fit right in there.
Well, that, just to be clear, is more about having an opportunity to buy stock of the company at a discounted rate. So you get basically embedded equity within the company. So let's say, for instance, XYZ company is trading in the market, in the public market at $20 a share. Well, you as an employee might be able to buy shares at $18. And so you have $2 in equity per share that you have. Those are typically named employee stock option plans. And so that allows you're not always able to take a tax deduction for that because typically it's not inside of a retirement account, but there are some that do.
Okay. So you talked about being physician owners,
Yep.
okay? So say you have a medical practice. When you look at that, do you view it as, within the portfolio, do you view it as an asset to be sold, or is it more of an income generator?
Both, right? So think about it like this. If you have rental property, right?
Okay.
If you own the property, let's just say it's free and clear, or your mortgage is a lot less than what you actually are getting in rental income, then that's a cash flow play, right? But if you were to sell said property, based on somebody paying the mortgage for you over that time period and paying pretty handsomely, then you have the capital gain event, which is you selling the property for what it's worth, at that time. So we talked about this offline. It's both. So while you own it, it's income. When you look to possibly sell it, right, you retire or whatever the case may be, then you can do a hybrid situation of one or another. Some people sell their business as a lump sum. Your practice is generating, 7 figures a year. Let's call it $2 million a year in revenue. Somebody may pay you 3x that, right? So they could pay you $6 million off the top, and you're out of the business totally.
Okay.
Or you could say, hey, give me $1 million up front, and then I want to pay out over time, over a certain term, of XYZ amount per month, per year, right, to be made whole.
Mailbox money.
Bingo.
Right.
So
I
an
like
annuity,
that.
right, so to speak. So that there's different ways to package it based on what you're looking for. Some people want the lump sum, say, hey, I'll go to my trusted advisor, Lamont McIntosh. She'll handle that $6 million for me. But some people's like, you know what? Give me $1 million. That'll get me right. And then I want $500,000 for the next 5-10 years or whatever the case may be.
Okay.
Does that make sense? So you can kind of determine those factors. Obviously, just like any other market, there has to be a buyer willing to buy for those terms and a seller willing to sell for those terms.
Okay. So everyone, a wealth of knowledge that was just given to us. I hope you're able to take it, do something with it, and please share this with your friends.